Well Health just got a new price target of $10. Let's talk about this. What's going on, you guys? My name is Daniel, and here on this channel we talk about stock market investing. And in today's video we're going to be revisiting Well Health Technologies. And for those of you guys who've been following along on my channel, I've been following Well Health Technologies and their journey as a company since they were trading at around $1.70 per share, and today they're sitting at around $7.90 per share. So the company has grown massively, and this is only in the past 5 months. If you guys have never heard of Well Health Technologies, you can find their ticker symbol on the TSX, and it's WELL. They trade on Wealthsimple Trade as well as Questrade, and if you don't know what these are and you're interested in starting stock market investing, then I suggest you to check out the links down below where you can sign up for Wealthsimple Trade and get $10, and Questrade, if you sign up today, you get $50. If you want to know more about Wealthsimple Trade, click on the video right up here, and if you want to know more about Questrade, I have a link in the description down below. Anyways, let's get to Well Health Technologies. So there's an analyst from Desjardins, David Newman, who raised his price target last Thursday from $9.50 all the way to $10. So an even $10. If Well Health Technologies stock price today of $7.90 grows to $10, that's a total price appreciation of around 27%. The current market cap of the company is $1.24 billion, and the total number of shares outstanding is 156 million. And if Well Health shares were to go to $10 per share, then the total market cap would be somewhere around $1.5 billion. For a company that was just around $300 million when I started investing it about 5 months ago, to be able to become a company at $1.5 billion, that is a huge gain, especially since it'll probably be a time frame of 1 year. First off, if you don't know much about Well Health Technologies, they play in the digital health space, as well as they own their own clinics. To be exact, they own 20 clinics, as well as they have partial ownership in a couple more. They're Canada's third largest EMR provider out there, and they gained this title in the matter of a couple years. They also started offering a telehealth service through their Virtual Clinic Plus platform as soon as the pandemic hit, and recently they completed the largest bought deal offering that they've ever had in the company's history. And this deal size was $80.5 million, and this came just a month after raising $23 million in a private placement round with Sir Li Ka-shing. And he's one of the greatest investors in Hong Kong. I believe he's currently around the second richest man in Hong Kong, and he's also invested in multiple rounds of Well Health Technologies. This is probably his 4th or 5th round investing, showing that this guy is super bullish on Well Health Technologies and is still willing to buy at these prices. Now, I just touched on Well Health's latest round of financing of $80 million, and you guys might be thinking, well, Well Health Technologies has been raising quite a bit of money. Isn't that a lot of dilution for shareholders? Let's talk about dilution. So for Well Health Technologies, I don't see dilution as a very big problem. And dilution only becomes a problem for a company if they're not actually growing their underlying business. For Well Health Technologies, they're growing their underlying business, and the confirmation we have of this is the revenue growth quarter over quarter. And it's been pretty stellar in the past few quarters, anywhere from 40%, ranging all the way up to like 300 or 400%. So every time Well Health Technologies raises some money, they're going to put that money into good use, acquiring new assets, and ultimately building up their revenue. For companies that dilute shareholders and don't see any returns on the stock price are those that use the money for sustaining activities. So maybe just like keeping the business alive and funding it off of debt. They're not growing at all, and possibly they're in a sector that's also seeing dwindling business. Another example of a company that dilutes shareholders and doesn't actually increase the stock price is one that takes this money and uses it for research and development, and if that development ultimately fails, then that money is completely gone to waste because that development produced nothing, and they have to raise another round of financing to fund their next round of development. So these types of companies you have to watch out for when they announce funding rounds. For Well Health Technologies, they're not a company that's doing that because they're growing their underlying business through mergers and acquisitions. If you go onto the news page of Well Health Technologies, you can see all the recent news in the past like 3 or 4 months. They've done multiple acquisitions, as well as they rolled out new digital platforms for health. And if Well Health Technologies doesn't actually raise money and dilute shareholders, this would actually harm the business because they would be going a lot slower. They would try to develop all their stuff in-house and rely on their revenues, which are still small, to grow the business. Instead, now as shareholder capital, they can go out there and buy assets immediately and have that revenue come onto the income statement for the next quarter. If they were to try to replicate the companies that they're buying, it would take them multiple years of development, increase investor risk, as well as they would probably end up lagging behind the competition. So I personally am not worried about the dilution that WELL Health is presenting investors when they do multiple capital raises, and I think they're going to continue raising money, assuming that the share price continues to go up. Some of the most notable activity that WELL Health Technologies has done in the past quarter is that they launched 3 different business units. This includes the digital health apps, cybersecurity, as well as their allied health network. On top of this, they made a major acquisition in the previous quarter by acquiring a majority stake in Circle Medical Health, which operates in 35 states for telemedicine. And this is their first step into the United States for telehealth and other digital health platforms. If you haven't seen my video on why I believe WELL Health Technologies is a 10x opportunity, I definitely recommend checking that out right here because it'll give you a good idea of what I'm thinking and why I'm investing in WELL Health for the long term. So ultimately, this analyst, David Newman, gave WELL Health a price target of $10 because of all the M&A activity. If you've been following any stock in the telehealth space, you'll notice that these larger companies are picking up a lot of these smaller companies. For CloudMD, they've bought at least 4 or 5 or maybe even 7 companies in the past quarter, and WELL Health Technologies has also bought around 3 to 4 different companies. And a lot of these are clinics as well as different sort of telehealth apps as well as digital platforms. And when these large digital health companies start buying up the smaller players, then we can see a consolidation in the space, as well as a lot of these business units that come under a parent company become a lot more efficient. So the gross profit for each of these business units that they end up buying out increases because there's things like redundant HR people, finance people, as well as maybe some redundant engineers can be cut off the payroll and ultimately costs can be reduced. If we look at WELL Health's stock price today of $7.90, any value investor would look at that and be like, no, way too expensive right now. The price to sales ratio is like above 20 and they're not even making any sort of earnings. They have a 0 or a negative PE ratio. How could anyone invest in that? A quick tip for you guys who are beginners out there, you have to know that the stock market is actually forward looking. So people don't really care about what happened in the past or what's happening today. They care about what's going to be happening tomorrow. So oftentimes the stock price actually reflects the company and what people believe it's going to be doing in the future. So for WELL Health Technologies, the fact that it's trading very expensively compared to currently what it's producing in revenue shows that investors are very bullish for WELL Health Technologies in the future. And they believe that the company can continue to expand and grow at very rapid rates and eventually be profitable enough to command the current market cap that it has right now, but in the future. Some other exciting news that Newman gave in his price target update. So he believes that WELL Health Technologies will also become EBITDA positive in Q2 of 2021. A company with positive EBITDA means that it's profitable at an operating level. Essentially, it sells products at a higher price than the cost it is to make them. So for WELL Health Technologies, some of their costs are labor as well as technology development. So overall, the future looks fairly bright for WELL Health Technologies, but now let's jump into the charts to see what we can see from a technical analysis standpoint. So up on the screen here, I've thrown up a chart and it hasn't changed since last time when we did a technical analysis on WELL Health Technologies. And if you want to see that video, click right up here in the right hand corner where I go over 3 different telehealth stocks, Jack Nathan Health, CloudMD, as well as WELL Health Technologies. But focusing on WELL Health Technologies, we can see in the chart here that there's an ascending channel. And we can see this channel pattern has held quite well for the past couple of months. We can see that it's bounced off the channel about 1, 2, 3, 4, 5, 6 times. And that 6th time was just today. And it's bounced off pretty hard. We can see that green candle is quite a strong candle upwards. And maybe this is because of the price target that the analyst put out. And also combined with the markets just doing fairly well today. The markets were pretty depressed since last Thursday when David Newman came out with his revised price target. And that's probably what ultimately muted WELL Health stock. If you're looking to swing trade the stock, then buy at the lows of this channel and sell at the highs. But if you see WELL Health stock break below the bottom support line, then cash out right away because we could probably be in for a downwards move. And if Well Health stock actually breaks above it, then we could see a bullish pattern upwards and probably a lot of investor buying in. And these patterns usually generally ring true because it's not just humans trading and looking at these patterns, but there are algorithms out there that look for these patterns and scan for them. And when they see these patterns, they buy in heavy. So after looking at the charts, currently what am I going to do with the stock? I probably am just going to keep holding right now because the stock has still ran up quite a bit. My position stands roughly around 400 shares in my Wealthsimple trade portfolio, so I think I'm good with that right now. But if we see the stock price drop possibly below that channel and have a move downwards, then I might be interested in picking up more shares. Let me know your thoughts down below about Well Health Technologies. Are you buying it? Are you selling it? Are you going to trade it for CloudMD? As well as click these videos right on the screen here if you want to learn more about Well Health Technologies or CloudMD, which is their major competitor in Canada. I'll see you guys over there if you're going to watch those. If not, keep up the grind and have a great day.